Hi, good afternoon, everybody. We'll just wait for a couple of more minutes for more participants to join. We'll start at around 12:05. So I've been given the go ahead to start. So today we have another interesting topic called investment gamification, and along with me we have another teammate from the strategy team, Aishwarya. It's her first presentation. So let's go ahead. So two slides always on all the presentations. So this is how market cycles work. Long-term cycles, short-term cycles, they all work the same way. There is a period where things do extremely well. You hear people talking about why don't you buy this, why don't you do this, and ultimately it leads into a bubble. That bubble is basically a greed bubble. It's over optimism, and you hear everybody say buy, buy, buy. Then when the flip happens and when fear does come in, when there's more pessimism in the market, you see everybody starting to tell, do you know this is not something that you should be doing? You should sell, you should not save here, you should do this and you should do that. There's a lot of fear that comes in, and that's how market cycles usually work. Right. So for example, this is a period where there is an extreme over optimism towards equity, and you see a lot of greed coming into the market. You see a lot of money going into small and mid caps, and everybody here is in a buy mood, right? But when you see problems like this where there is periods of over optimism coming in, then the fear does come in. It comes in very swiftly. It doesn't take a lot of time for people to change their opinion and get very scared, right? So that's when pessimism starts coming in. So if you see a couple of days back as well, markets are on a tear. You would have been hearing everywhere some yen carry trade, and information flows very fast now. So yes, fear does come in very, very fast, right? So when there is over optimism, uh, that does so the panic that comes in can shake that sort of over optimism very, very fast, very, very quickly, right? So market cycles work in it's very, very long. It's even the short term cycles work in such a way where you can take advantage of times in fear. And what Milestones2Wealth does is that we encourage investors to take part and participate more only when there is a period of fear, right? So Milestones2Wealth is a behavior oriented program. It is not a platform that gives you buy and sell recommendation, but rather helps you set milestones to make sure that your wealth creation journey is very, very simple, right? So what we do during pessimism, right? So always there will be parts of the market where there's fear, parts of the market where there is no fear, which is extreme optimism. And what we try to do is make sure to park your money very conservatively and participate more in times of fear. So that usually happens like it is a boring market for everybody to save their money in. That happens in a lump sum SIP, STP, step up SIP. All these modes are when we start channeling your money towards areas that are cheap in terms of valuation, but at the same time have a lot of scope for growth, right? And then when the exciting market does come in, you go out there and start reaping the benefits, right? And that benefit will only come when you set a particular milestone and reach that particular milestone for you to set the next particular milestone. Only when you have a goal is when you will be able to reap that particular benefit. Other than that, our entire endeavor is to create a habit for you to save more, and in turn it lead to an investment habit where you get to invest more of your savings, right? That's what Milestones2Wealth is. Now I'll hand over the presentation to Aishwarya. Aishwarya, you can take it forward.
Thank you, sir. So before we move on to looking at what investment gamification means and how it works, let's quickly take an example that we are all aware of, which involves Rummy and Dream 11. So next slide. So essentially, any game or any gamified interface, what it does is it's a game of minds, right? It basically puts our strategic thinking to test. It's all about, adaptation and keeping the opponents on their toes. And this is what Dream 11 and Rummy also does. In Dream 11, you'll basically be drafting fantasy teams based on, real world cricketers and demanding sharp decision making and an eye for performance. And on the other hand, what we do in Rummy Circle is that we meld cards into winning combinations by keeping our opponents on their toes. So these skills are no different from the basics that one needs while investing as well. We will now look at what gamification actually means. Next slide. So gamification basically means adding gaming elements to non-gaming environments with the aim of course, spreading more awareness, making it more participative in any area for that matter. So gamification means adding features like, celebrating milestones, rewards, making it a more interactive, user-friendly interface, etc. But do you think uh, this concept can be extended to the world of investments and trading? To answer this question, what we are going to look at now is something called the Robinhood application, which is a very famous application in this universe. Next slide. So what Robinhood application has tried to do is to essentially encourage greater participation in the stock market by adding game-like features to its app. But what they do this under the premise of furthering their mission and furthering their need to democratize finance for all. So they started this with the aim of wanting to bring in investors who have the knowledge of finance as well as don't and are not aware of the financial jargons, to bring them on board and make them aware of these concepts by giving them a more visually appealing platform to learn from. And when this came out, this of course revolutionized the landscape of stock trading, and the real-time market data also empowered the users to make informed decisions without, like I mentioned, the extensive need for financial knowledge or experience, which of course means that it made it more accessible and comprehensible to any user that came and logged on to this application. But like I said, we all know that this is an app that we can use to make investments, but how has it integrated the elements of gamification is what we're going to look at next. So the aim of any game or a gamified interface is to enhance the user engagement and delivering instant gratification. That's what keeps all of the users coming back to any app that they're using, because it celebrates the investor or the user of the app for whatever they're doing, and also helps them keep in check as to what they're doing, how they're doing, and how they can improve from here on. So the moment you say get to a milestone, the app sends a notification or there's a call to action, which makes all of us want to go back to the app and maybe do more. This is exactly what Robinhood Investment did as well. So in order to sort of enhance user engagement, what they did was they came up with achievement rewards. Robinhood rewards users for hitting milestones like completing any educational module, diversifying investment, or achieving any savings goals that they might have initially set. And it also helps them keep in check what they have to do from here on to achieve the goal. So they made stock picking and investing a very exciting, thrilling, and exhilarating lottery, so to say. And they also had progression-based incentives, which is quite useful because it also helps people to keep reviewing what they're doing, right? That's a basic requirement for any investor. So they had tailored rewards at different investment stages and phases. Say, for example, giving free stocks for beginners or advanced features for seasoned investors, etc. And when it comes to instant gratification mechanics, this is something that any app on this planet uses. This is not just related to any gaming application. This is something that is used by any application, because if the user does not get gratification, that means there's not going to be participation. So in this universe of investments, how Robinhood sort of made instant gratification was real-time rewards. Like I said, instant notifications on stock movements and immediate feedback on investment decisions, which always keeps the users hooked. There was these applications are what, like I said, introduced the thrill of trading. It constantly gave the users the excitement of the market with the joy of instant rewards, appealing to both new and experienced investors. So just a little bit of statistics before we move on to the next part. So where does this fun meet finance? Next slide. So what happens when there are applications like this that are in use? The essential aim is to encourage the base, the participation, the number of investors, how they're investing, making them aware, educating them about the concepts and methods of doing or sort of investing. So about 60%, 60% of the population they started making better decisions is one metric that they used to track this. There was a 60% increase in making informed decisions. There was about 80% users that understood all of these complex concepts better. And most importantly, 75% users joined these applications due to the gamified features. It gave them an incentive to join, to invest, to learn, and to grow, which is the primary concept or sort of the foundation of investing in stocks or mutual funds. Which brings us to do's and don'ts. So in any gaming platform or gamified interface, there are going to be certain do's and don'ts, more so because of investments as it involves personal money. The first do will be to be smart and wise. If one cannot sort of comprehend and be in touch with what is happening and make smart decisions based on market performance, it's not going to help. The investor or the user must make an effort to sort of stay on board with any changes that are coming in order to make their portfolio a better performing one. And of course, whether it's a game or whether it's in real life, when you're dealing with your advisor, it is very important to set clear goals. You have to define your investment goals and make sure to stick to it, and also constantly make it a point to track performance. And since it's a gamified interface, you're going to get rewards. But it's also important to use these rewards wisely. So if the platform offers rewards for certain actions, one should focus on those that promote good financial habits like regular savings or portfolio, as opposed to chasing them for their own sake. You don't chase returns, right? And we set reminders for regular reviews. It's imperative that one reviews their portfolios regularly to see how they've performed, what they can do to get ahead, and make their portfolio a better performing one. We come now to the don'ts. The first and the most important one is to exercise caution and due diligence, because more often than not, these apps or websites, they tend to make certain unrealistic claims, or they promise extensively large returns, which even make it hard for us to believe. But since it's a gamified platform, people might get carried away to put more money into this, and it might not sit well with them. So it is very important to exercise caution and due diligence before you get into this. And like I mentioned before, one shouldn't chase rewards. Avoid making investment decisions solely just to earn badges or points or other rewards, because most of these gaming interfaces are competition based, and you're going to be competing with multiple other investors or users who are coming on board. So immediately the thought is going to be to outperform the other one at any cost, which might not necessarily do well. So you might be on the disadvantageous side if you chase rewards and make impulsive decisions. So don't let gamified elements pressure you into making hasty decisions. While they are very useful, they're a very useful means to understand, learn, grow, invest, and secure a future. But it is important to understand these do's and don'ts to have make better use of money. Which brings us to a very interesting question. Now that we know the do's and don'ts, do you think you should game with your savings? Isn't that an interesting question that everyone can answer, right? Next slide.
So I think now we'll play this game. So usually we take these polls. I think in one of the webinars we had seen asset classes, and now we thought that we go a little deeper into seeing how gamification actually works. Because when we do direct stock investing via platforms, you need to understand that there's a lot of thrill, there's a lot of impulsive decisions that you take, and the leaderboard competition basically is you talking to your peers and then taking that decision to say, you know what, he's able to do it, I also want to do the same thing. Right. The whole point of instant gratification, right? She was talking about instant gratification. You want to see things happen very, 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 very fast, right? That's not how building wealth usually works, right? If you see how the previous generation was built today, whatever we are because of the previous generation, because of their hard work. Likewise, there's a lot of hard work that goes into creating that kitty for your savings, and in turn make sure that that kitty makes money, and in turn helps you fund all your goals, right? So now we'll play this sort of game. Now, is it easy to play the game of the markets? You can put your answers in the chat box. There's already a question to say, where are we in the market cycle? Are we near the end of a bull market? See, from a short-term cycle, if you see it, it'll always look like you're at the end of any market, right? But from a long-term perspective, today we are doing a lot of capacity addition. We are putting in a lot of money. Public capex has gone up. Likewise, private capex also should pick up in the next couple of years. So when that happens, we are creating new capital that will get more and more revenue generated. So naturally, it looks from a short-term cycle, there is polarization of valuation, which means that a lot of things have already been factored in. So any small disappointment that can come in can have large ramifications on the market, right? So is it easy to play the game of the market? Two comments came saying no. Somebody said yes. 3 no's and 1 yes. No. 4 no's and 1 yes. 5 no's and 1 yes. Okay, so there's another question. Do you think it's easy to win this game of the market? A lot of you said no for the previous one, to say it's not at all easy to play. So naturally, I'm not going to win at it. No. Yes, no, and no. It's in caps. No. Okay. Hardly any yeses. Many no's are coming. Okay, let's boost up some confidence here. If there's so many no's coming, let's boost some confidence. Okay, so these are actual mutual fund returns. These are actual funds. We didn't want to name the fund, but this is the CAGR of these funds from 2014 up until 2018. These are all large funds, and this has nothing to do with it being a small cap or mid cap. We've just taken based on a conservative risk profile. If a person does it in this fund A, B, C, D, these are the returns, right? From a CAGR perspective. Now, why don't you guys take a good look at it? Because the next question is, which, assuming you started investing in 2014, which fund would you invest in? A, B, C, or D? You can put your answers in the chat box. So I'll put it here so you get to see the number. So, which fund would you invest in had you started investing in 2014? Is it A, B, C, or D? All option is not there, no cheating. A, B, C, or D. Okay, C. All right. C. Okay. Everybody's C. Okay. B. Okay. Wait. If it is C for sure, but we don't know at that time how much return it is capable of. Yeah, you're right. But you still made a point by seeing the review saying I'll do C. The whole point of investing, the whole point of gamification that has actually happened in direct stocks, right? If you go to any of the platforms, is that is that thrill, no, that instant, right? You're getting notifications. There's always a hook that comes to you, right? So you're always wanting to take a decision. You're always wanting to make a choice, right? So you choose what is the best performing based on the rear view, right? You don't see ahead. You don't try to even look ahead, but you see, okay, this has done well, I'm going to be sure that this is going to be doing well for me, I might as well do this, right? So at 2014, if you see, you're going to see the past 3 year return, right? Let's say even if you start at 22, you will see the past 3 year return only and do it's all rear view investing, right? So now there's a comment saying we can't answer by just seeing the numbers. Yeah, you're right, but most of the decisions that investors make are seeing the numbers only, right? Be honest, everybody just sees numbers, nobody sees anything else. Whatever is the number is what you're able to take that decision on, right? So I'm going to go with a majority of investors have said C, and probably one or two who said B, right? Now let's look a little bit ahead, right? If you look at 18 to 22, right? uh, Investors who chose C, your return in that particular period is 10.5%, right? Where it was 16, that fund return was 16, it went through a very turbulent time. It is 10.5%, right? And if you see, things have actually changed. Yeah, the period was also bad between for that 1 year, but when you look at cycles from a long-term perspective, and that gets cut, shorter term perspective, you need to see the events that take place and how can it have an impact on your savings, right? So it's not that you're not growing at a bad rate, you're growing well, but then what you were growing before and what you're growing now is drastically different, right? So have a good look at this number again. Now I will ask you a question. Say, does your answer change? And if it changes, what are you going to do next? Put this again. Now your answer, does it change or not seeing these numbers? 18 to 22. Okay, two no's. Okay. Does your answer change? And you can put your comment also as to why you don't want to change it. If it's yes, please give a comment. If there is no, please give a comment. Somebody said, yes, I'm not going to get stuck with C. I'd rather choose B. Okay. Yes, I would move to A because the return is a bit stable. Okay. So I'm guessing that you were doing some other fund, and then 18, you take the call, say, okay, I choose to exit. and you take that call to exit and you go to some other fund and you take that call again, right? So you're invested for 5 years, you take that call and then you again stay invested for the next 5 years in another fund, right? Many knows saying no because I'm a conservative investor. Still, I can't buy just by seeing the numbers. So for 10 years you have lost saying I have not seen the I can't take a decision based on the numbers. So 10 years of compounding you have lost, right? Where you can somewhere grow between 11 and 12%. You lost that period of growing for 11 or 12%. Okay, appreciate it. Uh, there's a comment saying no, no, I'm not going to be stuck. I'll choose B. Okay, you chose something else. All right. Uh, I'm not sure which fund is better. Anyway, my view is to hold for the long term. So I will hold. This is a very, very honest answer. This one is excellent. Where you said that I'm not sure, but I will be consistent and be disciplined with my savings and I will still hold. Right? You will still you will still stick your neck out, say, yes, I will definitely be there. And I'm patient, I'm consistent, and I'm going to be disciplined. Yes, that's very good. Right. So now I'll ask you a question. Now, after seeing all this, right, assuming you started investing in 2014, again, which one will you invest in? You saw the first 5 years, you saw the next 5 years. So this is one whole 10-year cycle. Huh? So now, assuming you've seen everything, does your answer still change? What would you do? Would you still be fund A, fund A, B, C, D? What would you choose then? Because what we will look at is how the tenure has performed because you've stayed invested. Here we've just cut across and seen that, okay, what is happening for 5 years and then the next 5 years. And there's a lot of change. Huh? Many of you said that, no, I don't know if, I don't want to be stuck here. I would rather move. Only if I'm a good astrologer, I will choose A. Okay. Fund A because it's less volatile. I'll continue in fund C. Okay, perfect. That's okay. You can take some time. You can still answer. No problem at all. D. Okay. Okay. So now, if you look at 14 all the way up until 22, how the first couple of years, the returns then versus the returns in the next 5 years, right? You see drastically there's a lot of difference from your starting point all the way up until your ending point, right? You will see a lot of volatility come in. You will see a lot of things take place. You will see events like COVID take place. Of course, in the next 10 years, we cannot predict what is happening, but you should be prepared that certain things can affect the market. There's a lot of volatility that can happen. There's a lot of geopolitics that takes place. Anything can happen in the future, right? But what you need to see from this particular data is that overall, right, whatever fund you sort of choose, you will be somewhere between 11 to 12% from a return perspective. Your first 5 years can be extremely good or extremely hard, and the next couple of years is where your savings actually cement into you making a lot more money, right? So always don't try to be I appreciate one comment, I will still hold. That actually shows a lot of patience, right? You don't know how things are going to take place, but you're still willing to be patient. You still want to contribute continuously into an investment vehicle, right? And make sure that you're having a particular goal to which you're saving to, right? So what the platforms do for you is that they do not show you how things take place. It's just instant gratification. But when you look at things from a long-term perspective, when you look at how cycles play out completely different, right? You gamification makes you look at just smaller aspects of things, but when you take 2 3 steps back, it gives you a broader horizon, and when you get that broader horizon, you're able to take better decisions with your savings, right? So if you see this particular data from 14 all the way to 22, what was outperforming is underperforming. What was underperforming actually is outperforming. Right, so there will always be a winner. There will always be a new winner in every cycle. There will always be a new loser in every cycle. Right, and to understand how things take place, so I've done a webinar on understanding how asset classes work and being multi-asset. Right, channeling your savings towards conservative parts of the market, towards asset classes that are conservative, will always help you outperform your peers as well as the market. Right, so how do you win the game of the markets? Be consistent, stay invested, show and maintain patience, be disciplined, and most important, right, is setting a milestone. See, the whole point of being consistent is to make sure that you're building this habit of making sure that whatever you're able to save, right, you're going to go and start investing in. Right. So the more you strive to do more, that is what Milestones 12 is actually meant for. It helps you. It gets you aware of how you can strive to do more. Right. So when you sort of partner with us, what we do is that first we take your risk profile test. We understand what is your ability and your willingness to take risk. Second, make sure that you're sorted on all the fronts. Your first line of defense is your insurance. So we make sure that you're very well adequated on the insurance front. And third, we do a financial health checkup for you. Make sure, like how you go to the doctor to understand, get a full body checkup to see what you can do, with your health. Likewise, we do the same way by giving a financial health checkup where we understand how financially fit you are. Right? Only then create that habit of being consistent where you can save more, ultimately channel it towards investment vehicles like mutual funds, uh, for you to meet your goal. And we do that only by setting a particular milestone. And we work with various investors who have a milestone of 2 lakhs, 5 lakh, 10 lakh, 25 lakh, all the way up until a crore. We want all investors that we work with to reach that crore milestone. Right, and we cannot do that unless and until we show these traits. Right, being disciplined is making sure that we don't stop our SIP. Today, when you see investors are willing to pause their SIP, investors are willing to stop their SIP without understanding how it can have a large impact on future compounding. Right, staying invested. Right, that's what being disciplined actually means. Stay invested. Right, and have a long-term approach. It's not all about the returns. It's always about behavior. The only reason of why somebody does better than you is not returns. It's that they have shown a better behavior than you. Right, so being patient matters a lot in the long term because you're investing for the long term. And I really appreciate that comment that says, you know what, I'm in this for the long term, so I will still hold no matter what happens. Right, what I would also suggest is that there has to take a review, that you need to take a review with a particular advisor, with your advisor, so that you're on the right path. Only when you set a milestone, work towards a particular goal, you should have periodic reviews. That should not be 6 months or 3 months or something like that. It should be annually, without you taking massive calls. The review doesn't mean that you need to change something. The review means that, okay, am I going on the right direction? What do I need to think of? Right. That's it. This is how you win the game of the markets. Being consistent, being disciplined, staying invested, setting a milestone, and most important of all, being patient. Right. And how does this sort of lead into your journey to fast track your wealth creation to a crore? So if you look at this, if you just keep sticking to your SIP and you just invest 70,000 rupees or whatever that case be, and you're growing between the same long-term average, right? It takes you 8 years for you to reach your first crore. So your first 8 years, your painful, hard 8 years goes into you building that crore, right? And then it takes you 4 years to the next crore. Then it takes you 3 years for the next crore because your compounding is working beautifully, right? And then by the end of the 20th year, you're adding a crore every year. So when we are setting a milestone to say, no, we want every investor to get to that position to save a crore, we are actually setting you up for 5 to 5.5 crores, because at the end of the 20th year, you've crossed 5 crores the target. Right. And that's enough for somebody who's looking to retire, enough for somebody who has goals that can be met. right, with this particular corpus. So it's not that hard to win for you in the game of the market. So it's very, very simple. If you just show those traits and continue going out and have and work with a particular advisor, only then you will know whether in the right direction or not, right? So the first 8 years, one it takes you 1 crore to reach. If you're just moderately growing somewhere between 11 and 12%, then the next at 4, and then the next at 3. So every crore you're cutting off time. Most important, you're cutting off time, right? You're not doing anything, you're just being consistent, you're just going straight, and everything else is working for you, right? So now I'll open the floor for Q&A. I put the number here. So if there's something that I've missed out, or you want me to go through a particular slide again, I'm very happy to do so, right? But I'll put the number here so that you understand. So if there is any particular question later, you can just send us a hi. And if you're not on the program, just send us a hi. Somebody from the team will get in touch with you with your requirement. You can put your requirement, and our team will get in touch with you, right? There's a question on, at this stage of the market cycle, how many percentage of additional money we can keep for lump sum investment that can be used to deploy during correction. However, otherwise, shall we deploy in gold and silver and rebalance? That's a very good idea, because see, again, you should look at your risk profile. So when just send us a hi, it's a beautiful question. So just for your knowledge, what you can do is, at this stage of the market cycle, look towards other asset classes. Your other asset classes needs to be gold, silver, debt. On the debt side, you would somewhere make something like 7.4, 7.5%, right? On the debt side. But ultimately, you can use that money when there is some problem. But other than that, it's still a very good rate for you to grow at on the debt side, right? Gold and silver. See, today's geopolitical scenario is very bad, and debt levels in the US are very bad. They're very high. Central banks, it's every man for themselves. They will do what's best for their country. We saw what happened with Japan. So by that logic, and inflation is very high in the US. So developed nations are going through a very bad cycle of inflation. If you look at Europe, if you look at US, so by that logic, right, you need to have alternate currencies, and that alternate currency is gold and silver. The one that we have access to is gold and silver. Yes. And how much of additional money we can keep for lump sum investment? See, always have, this sort of emergency reserve that is 6 to 8 months of expenses. Beyond that, whatever you have, you can park in debt, you can park in arbitrage, and you can use it for any sort of small dips that come into the market for your portfolio, right? So Swagat from our team did a very good presentation at 10 a.m. It was in Tamil, where he was talking about whether you should choose SIP or whether you should choose lump sum, right? And he was talking about how when you just do a lump sum once and leave it, how long does it take you to reach a crore, right? And when you do a SIP, how long does it take? SIP was far more better than that of doing a lump sum. But having this approach of keeping some powder dry whenever there is a correction, or whenever there's a, whenever something comes up as an opportunity, it doesn't mean that only when when the broad headline number goes down is when you should look to invest. No, but when you should look to invest is when the earning cycle starts turning around for particular segments of the market, and only then you can sort of put that money to use, right? But have some, depending on your portfolio. This is not to say that it's 5, 6, 7. No. It's depending on your portfolio size. It's depending on your total savings as how much you can have as dry powder to keep ready. Do we need to change SIP? See, never change your SIP, right? Redirect all new incremental savings that you're having towards asset classes, towards other asset classes. Don't change your SIP. Don't change, don't stop, don't pause. You need to let it compound continuously and keep on going. Market cycles will turn, things will turn. So when you're having a period where things are not doing well, use it to your advantage. Try to scale up more, unless and until there's a fundamental issue, right, with the fund or with the company. And until and unless something comes up, then is that only then it becomes a problem. Other than that, never stop your SIP, never pause your SIP. Always look to add incremental savings that you have towards other asset classes. Balance it out. Have a multi-asset approach, and we have a multi-asset approach on Milestones to Wealth as well. So we do keep giving lump sum calls via WhatsApp, and where can an investor do, when should an investor do. It's all based on your risk profile. There's a team that works day in day out. They're always going to be in touch with you. You'll always have a point of contact. They're working towards helping you reach a particular milestone. Yeah, so if you are already a part of Milestones and you're keeping some amount for lump sum too, you would have already gotten a lot of communication from our side as to what you can do with it. Is PPF a good investment for that? Yes. Yeah, we have some time. So if you do have any questions, please do keep them coming. We have a good amount of time before we can end. We are somewhere at the top. Where are we in the current market cycle? We are somewhere at the top. We don't know how far it can go, but wherever we've had a top, wherever we felt that there is a top, we have taken calls to head to safety, to build more assets towards conservative parts of the market. The reason I'm asking is based on market value. See, market valuation always look like it's expensive. There are parts of the market that are very cheap, right? And then there are parts of the market that are really really expensive, right? So overall, broad based, we are not at a peak, but we are quite high from a broad base. There are pockets of the market that are very cheap. There are some asset classes that are very very cheap, that are extremely cheap. So they are nowhere near its peak. They are somewhere at the bottom only, on the fear to no interest sort of side. Great. I don't think that we're getting any more questions. Gopi, can you just put the testimonial link here? Yeah. So if you're happy with us, if you're sad with us, please give us a review. We worked with a lot of investors. We are continuing to work with a lot more investors to help them reach their particular goal. And just rate us on Google. Just give us your feedback also. That will be very helpful to us. But thank you all for joining in on a Saturday afternoon. Have a great weekend ahead. We will continue doing more such webinars, more on interesting topics. We have started our journey on vernacular, and Tamil is where we are concentrating on first. So every week we are doing Tamil webinars. We are doing many topics, for Tamil webinars. So follow us on Instagram, follow us on Twitter, follow us everywhere. We are everywhere. Follow us on YouTube, and just send us a hi if you're not on the program. Somebody from the team will get in touch with you so that you're all up to date with our content. You're all up to date with what we are doing, and hopefully in time we get to partner with you and help you reach your milestone. Thank you so much for your time. Have a great weekend ahead.